Welcome to the Opening Bell Report.
Today, we've got a breakdown that absolutely demands your full attention. The focus of the analysis report we're looking at today is wild.
Truly wild.
It's titled, BATL stock explodes over 134% in a single day, what you need to know.
Yeah.
And we are looking at the exact anatomy of that move, what you need to know, how it actually happened, and what was really going on behind the scenes. We're talking about Battalion Oil Corp, ticker symbol BATAL.
It's one of those case studies that it makes you completely stop what you're doing.
Totally.
You literally just sit there staring at the chart, trying to figure out if your feed is broken.
Right, but let's put hard numbers to that feeling. Because words like exploded or skyrocketed, they get thrown around constantly in financial media.
They lose their meaning.
They really do.
Yeah.
But according to the analysis report we're working from, this stock gained over 134% in one regular trading session.
Which is just, for context, a phenomenal entire year for the S&P 500 might be 20%.
Exactly. And BATL did more than 6 times that in the span of a few hours.
Yeah.
So our mission today is to unpack the actual machinery of this parabolic breakout.
Yeah.
We're going to walk you through the data, separate the wild retail hype from the underlying financial reality, and figure out if this is a genuine rocket ship.
Or a very dangerous game of musical chairs.
Yes.
And making that distinction is the entire ballgame for you as a listener. Because when you see a ticker go vertical, the surface level price action almost never tells the true story. You have to look at the plumbing of the market.
Okay, well, let's unpack this. We need to start with the sheer scale of the price action because the numbers in front of us are just staggering.
They really are.
It's crucial to understand this wasn't some steady, persistent climb over a week.
No, not at all.
Let's look at the timeline. The previous day's close for BATL was $11.80.
A total unremarkable close.
Exactly, $11.80. But then the market opens the next morning, and it doesn't open at 12 or 13. It gaps up massively right at the open to $24.76.
Yeah.
How does a stock more than double when the regular market is completely closed?
So that's where pre-market trading mechanics come into play. During the pre-market, liquidity is incredibly thin.
Right.
You don't have the massive institutional presence or the volume that you see during normal hours. So if a catalyst hits the newswire before the bell and a few aggressive buyers step in...
There's nobody there to sell to them.
Exactly. There aren't enough sellers at $12, $13, or $14 to absorb that new demand. The ask price just keeps moving up and up until it finds a willing seller. By the time the 9:30 a.m. bell actually rings, the opening print is already at $24.76.
Anyone who held that stock overnight literally woke up in a different financial reality.
They did.
And it just kept running. From that massive open, the data shows it pushed to a dizzying intraday high of $29.70 before finally closing the regular session at $27.68.
Yeah.
Marking that historic 134.58% gain. Imagine checking your portfolio at lunch and seeing that.
It's the dream, right?
Yeah. But the price is only half the story here.
What's fascinating here is the sheer volume of the trade. If you want to understand how these vertical spikes sustain themselves, you have to look at how many shares are trading. The analysis report highlights that over 68 million shares traded hands during this single session.
Which sounds like a lot to anyone listening, but give us the relative context. Why is 68 million so important?
You have to compare that 68 million to the company's float. The float is the actual number of shares available for public trading. It excludes insider shares or restricted stock.
Right, the actual supply on the open market.
Exactly. BATL's float is relatively small, so when 68 million shares trade, that volume completely dwarfs the actual supply. The entire available supply of shares is turning over multiple times in a single day.
Wait, so the exact same shares are just being bought and sold over and over again in a loop?
Precisely. The velocity of the trading is extreme. Think of it like a highly anticipated stadium band deciding to play a secret show in a 200-person dive bar.
Oh, like that analogy.
Right. The dive bar capacity is your float. The tens of thousands of fans outside, desperate to get in, that's your demand and volume.
Got it.
The first 200 people buy their tickets, walk outside, and immediately sell them for double the price to the next group. That group turns around and sells them for triple. It's a localized frenzy.
And the speed of those transactions, combined with the tiny supply, just blasts right through all historical resistance levels.
Creating a monster opportunity for early traders.
Okay, I get the mechanics of the squeeze, but that still leaves the big why. Exxon and Chevron didn't randomly jump 134% that day.
No, they didn't.
Why this specific microcap stock? Why them?
The sources break this down into two distinct catalysts that basically collided to form a perfect storm. The first is a macro tailwind. escalating geopolitical tensions in the Middle East.
Sure, but Middle East tensions impact the entire global energy market. How does that directly trigger a 68 million share frenzy in a company most people had never heard of?
It comes down to how aggressive retail day traders hunt for leverage. When tensions rise in a major oil-producing region, crude oil futures spike. Traders instantly know the energy sector is going to be green for the day.
Right, a rising tide lifts all boats.
Exactly, but buying a mega-cap giant like Exxon gives you maybe a 1 or 2% move. If you're a retail trader hunting for massive daily returns, that's just not enough.
You want the big swings.
Right, so they look for microcap energy stocks. These tiny companies catch what's known in the market as a sympathetic bid.
A sympathetic bid, meaning they're just getting dragged upward by association.
Yes, it's an associative frenzy. Traders aren't buying BATL because management announced some revolutionary new drilling technique.
Right?
They are buying it because it has the word oil in the name, its market cap is tiny, and crude oil is dominating the morning headlines.
That reminds me of the crypto craze back in 2017. Remember when Long Island Iced Tea changed its corporate name to Long Blockchain Corp?
Oh, absolutely.
And the stock shot up like 200% purely because they added a buzzword.
It's the exact same psychological mechanism. The fundamental business hasn't changed overnight, but the associative keyword acts as a beacon for speculative capital.
Wow.
But the macro environment was really only the match. The gasoline was the second catalyst, the momentum squeeze.
Right, because you mentioned the dive bar analogy, but it's not just humans standing outside the bar scalping tickets, is it?
Not at all. And this is where the modern market heavily differs from 20 years ago. The analysis report specifically flags the role of algorithmic trading here.
Okay, break that down.
You have to remember, retail traders are sitting there watching the chart, feeling that classic FOMO, fear of missing out. The massive open at 24.76 triggered intense FOMO.
They see a green candle going completely vertical and rationality just goes out the window.
Exactly. But alongside them, taking the wheel, you have highly sophisticated automated trading algorithms scanning the market for anomalies.
So what exactly are these algos looking for? Because they don't feel FOMO. They don't care about Middle East news headlines in a human sense.
They look at the math. They scan for anomalous, volume-weighted average price breaks, massive pre-market gaps, and low relative floats.
Just pure data.
Right. The second an algorithm detects that BATL is turning over its entire float in an hour with extreme upward velocity, its programming engages. It starts buying aggressively, completely indifferent to the company's fundamentals. It's just riding the momentum math.
So the algos ignite the rocket, the retail crowd sees it on their screen scanners and chases it, which drives the price higher, which triggers even more algo.
Exactly. It's a massive feedback loop.
Human emotion driving retail buyers, and cold, calculated algorithms detecting that emotion and amplifying it.
And that combination is what squeezed the price to its absolute peak of $29.70.
Here's where it gets really interesting, though.
Oh, yeah.
Because everything we've talked about so far sounds like a massive victory if you're long on the stock. It's the kind of chart you take a screenshot of to show your friends.
Absolutely.
But this is exactly why you have to look under the hood. Because while that chart looks like a flawless rocket ship on the surface, the analysis report issues a massive, glaring reality check regarding Battalion's actual financial foundation.
This is the pivot point in the story, and it's where the narrative completely flips. If you're a day trader, you might only care about the momentum for 3 hours.
Right.
But if you're a retail investor looking at that $29 price and thinking, wow, the market is valuing this company highly, maybe I should buy in for the long haul, you are walking into a trap.
And the biggest red flag in this entire breakdown is the private placement.
Yes. Right as the stock was soaring into the high 20s, literally while retail traders were fighting each other to buy shares at $28 or $29, BATL confirmed a $15 million private placement with institutional investors.
Okay, let's break this down, because the terminology sounds like standard corporate finance, but the reality is shocking. A private placement is when a company creates new shares and sells them directly to institutions to raise cash, bypassing the public market, right?
Correct. They are raising $15 million in capital by issuing new equity to a specific group of institutional buyers. But the catch here is the pricing of those shares.
This is the crazy part.
According to the analysis report, these newly minted institutional shares were priced at a heavily discounted $5.50 per share.
Wait, hold on. I need to stop you there.
Go ahead.
If the open market is aggressively bidding the stock up to nearly $30, why on earth would the company's management agree to sell shares to institutions for $5.50? That feels like gross incompetence.
It looks that way on the surface.
Aren't they leaving millions of dollars on the table? Why not just sell shares into the open market at 28?
It's a great question, and it highlights how detached this institutional valuation is from the retail euphoria. You have to look at the timeline and the liquidity. First, institutional deals like a $15 million private placement take weeks to negotiate, conduct due diligence, and legally structure.
They don't happen in a 3-hour window.
Exactly. The institutions were likely negotiating this when the stock was much lower.
So the paperwork was already in motion.
Right. And second, the institutions know the company's books inside and out. They know what the company is actually worth fundamentally. Furthermore, management can't just dump $15 million worth of shares onto the open market during a highly volatile algorithmic short squeeze without risking a catastrophic collapse of the stock price.
And potentially running afoul of SEC regulations.
Exactly. The $28 price is a mirage created by low supply and FOMO. The $5.50 price is the reality negotiated by deep-pocketed investors who have actually seen the balance sheet.
So the smart money, as they say, is valuing the equity at roughly $5, while the momentum crowd is valuing it at 30.
Yes. And if you look at the severe cash burn outlined in our sources, it entirely justifies that $5.50 valuation.
Yeah, the fundamentals are grim.
Battalion Oil is operating at a heavy loss. The report details that their trailing 12-month net income, which gives us a full year's picture of their profitability, sits at a bleak negative $55.17 million.
Negative $55 million.
Over the last year.
If we connect this to the bigger picture, it completely changes the narrative of that $15 million capital raise.
How so?
Well, often a company raises money to fund an exciting new drilling site or to acquire a competitor. It's a sign of growth. But with a trailing net income of negative $55 million, this $15 million raise wasn't a victory lap for a thriving business.
It was a desperately needed lifeline.
Exactly. It was a lifeline for working capital because the company is actively burning cash just to keep the lights on.
They needed the money so badly they were willing to dilute their existing shareholders at $5.50 just to survive. Precisely. The market was throwing a massive party at $29 a share, but inside the corporate boardroom, they were patching holes in a sinking ship with a $5 life raft.
Which brings us to the inevitable conclusion of a trading session like this, the aftermath.
Gravity takes over.
Because what goes up that violently, completely detached from its fundamental reality, eventually has to answer to gravity. And gravity hit exactly at 4:00 p.m. when the closing bell rang.
The transition from the regular trading session to the after-hour session is brutal for momentum stocks. The liquidity just completely dries up.
The data states that the absolute moment regular trading ended, the stock dumped. It fell over 16% in the after-hours session, immediately dropping to $23.16. So what actually happens at 4:01 p.m. to cause that?
The momentum algorithms turn off and the retail buying pressure evaporates. During the day, the sheer volume was keeping the price artificially inflated. But once the bell rings, the professionals take over.
The early buyers.
Right. The early buyers, the ones who initiated the squeeze at $12, they aggressively hit the sell button to lock in their profits. And the institutional shorts who recognize the fundamental disconnect start hammering the bid.
And who is left on the other side of those sales?
The latecomers. The retail traders who bought in at 27, 28, 29, convinced the stock was going to 40 the next day.
Essentially leaving late-coming retail traders holding the bag.
Exactly. When the early money exits and the algos shut down, the floor falls out. Those late buyers are trapped in positions that are suddenly worth significantly less than what they paid in a company that just told the world its shares are fundamentally worth $5.50.
So what does this all mean? If we step back and look at the entire arc of this data, from the quiet 1180 close to the algorithmic explosion up to 2970, a 550 institutional reality check, and finally the after-hours dump. What is the core takeaway for you, the listener, trying to navigate this kind of market?
Well, based on the analysis report, BATL was a masterclass in momentum and volatility. If you are a purely technical trader who understands the mechanics of sympathetic bids, who recognizes the math of a low-float momentum squeeze, and who strictly manages their risk, it was a brilliant short-term play.
A great opportunity for those who timed it perfectly.
Yes.
But if you didn't understand those underlying mechanics, it was a financial landmine. Paying nearly $28 for a distressed company that just diluted its equity at $5.50 is an incredibly dangerous financial game.
It illustrates the vital difference between a short-term momentum trade and a long-term fundamental investment. They are two completely different sports.
Right.
Recognizing the macro events like the Middle East tensions is helpful, but understanding the micromechanics, the float, the algorithm behavior, the volume, and how to read the implications of a private placement, that is what actually protects you from getting burned.
You can never just look at a skyrocketing ticker and assume the business itself is thriving. You have to look at the plumbing.
Absolutely. And it actually raises a much broader, slightly unsettling question that I think is worth reflecting on after dissecting a case study like this.
Let's hear it. Leave us with a final provocative thought.
We just walked through a day where market algorithms and retail FOMO pushed a distressed company stock up 134% in a matter of hours. The public market essentially declared the company was worth almost $30 a share.
Right.
But simultaneously, the institutional insiders, the people with the absolute most visibility into the company's real financial health, priced that exact same equity at just $5.50 a share.
The disconnect is huge.
So what does that actually say about the true value of a stock in today's market? Are everyday investors still trading the value of companies, or are we entirely at the mercy of trading human psychology against algorithmic momentum?
That is a fascinating question to leave on. It really forces you to question what the blinking green and red numbers on your screen actually represent.
It certainly does.
Thank you for joining us on this deep dive into the absolute roller coaster of Battalion Oil Corp. We hope this breakdown helps you cut through the noise, spot the traps, and keeps you sharp the next time you see a stock going parabolic. Keep questioning the data behind the headlines, stay curious, and we will catch you on the next one.
Don't forget to like, share, and subscribe for more.